Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hello, David. How are you?
Hi, Sarah. I'm good. I've got a lot more sleep this week than I did last week.
I know it does feel like everything's settled down quite quickly. I mean, there's news stories coming up about various different appointments, but it feels like we've kind of gone back to sort of normal.
Yeah, exactly. It's amazing how quickly and we've been saying this. I know everyone sort of sighs every time we say that elections don't really matter, but hey, look, the last week shows you that markets move on pretty quickly. Look, we'll be back again. There'll be developments on January 20th and beyond, and I'm sure we'll be discussing them. But for the time being, it's smooth sailing.
Okay, fingers crossed it remains that way. Okay, quick fire numbers round first of all. You go first.
I'll go first. I'm back to my random esoteric numbers, but it's numbers that I like, so that's the main thing. So The number this week is 60 million.
Right.
60 million metric tons. That's your global daily consumption of beef, right? And why is that relevant? Because if you look at the chart, it looks like we're at peak beef. It looks like the growth of beef consumption since 2010 has basically edged up about 3 million tons a day. Compare that to chicken and pork, which is up nearly 25 million tons, and in the case of pork, about 12 million tons. So the point is that, remember, in the context of discussions we've had about carbon intensity of agriculture and specifically proteins, beef obviously is the one that gets all the focus. And actually, when you look at global consumption of proteins, beef is pretty much at full saturation. We're at peak beef. The big growth markets are pork and chicken. So that's my soft commodities fact of the week. I
was going to say, what about, I'm putting you on the spot here. What about the sort of, there was that sort of development, the sort of innovation in sort of lab grown meat, for want of a better word, that hasn't really impacted real meat markets.
It hasn't really, and anyone that's been in the supermarket and had to make a choice who don't have strong sort of obviously lifestyle views on eating beef or eating meat or vegetables has looked at it and decided I think it doesn't look desperately appetizing. So we'll see, but no, it hasn't quite taken off in the way that people thought. I think people are, if you look at trends in consumer behavior, and particularly, I was reading a paper the other day looking at vegan food and how that's been taking off. People are making just lifestyle choices to eat healthier as opposed to substitute meat with meat replicants or fake meat.
Which, if you're making a choice to do it for ethical reasons, you don't want to eat something that's like meat at all, do you?
No, exactly. What's your number? Come on. Let's
my number. I've been very boring, as I always do. I've got a number that's related to this week's topic, 21 million.
Okay. Go on then.
That is the total number of Bitcoin available. There is a finite number of Bitcoin,
of
21 million, of which, now when I checked earlier today, on the day of recording, how many had been mined? 19,875,712 and a half. I don't know where the half comes from, but anyway, that's how many. So apparently they're about 450 are mined a day.
And the countries they're mined in is obviously, we're giving away our topic, aren't we?
We are going to talk about, well, not just Bitcoin, because obviously we've seen this massive rally in Bitcoin off the back of last week's election result. But we are going to be talking about sort of Bitcoin, but the wider sort of crypto market. So what are the sort of three themes that you want to kind of look at today?
Well, I'll break it down, but before we do, it's a thank you to, I think, one of our listeners who proposed the topic as a suggestion, and we are always open to suggestions, so please keep them coming in. And I thought about the takes that people have already had on Bitcoin and on digital currencies. So I wanted to try and do something a bit different. So we do need to start, though. Our first subtopic is going to be the ideological foundations of money and Bitcoin, and its appeal as an alternative to fiat currency. We have to talk about that because that will then help inform, I think, our second two topics, which is the integration with traditional finance. So that's about innovation and how this is now coming into TradFi or mainstream finance, and the associated impact of that. I mean, there is an environmental cost of Bitcoin, and we need to acknowledge that as well. And then the third thing is going to be our blue sky forward-looking applications for not just Bitcoin, or even crypto, but perhaps for the technology more generally. So we could talk about central bank digital currencies. We could talk about blockchain as a technology and where that might take us.
Okay. All right then. Well, let's start then. Back to basics. What's the difference between a fiat currency and crypto?
Yeah, well, this is the economist in me that is just finds this the most fascinating of the three topics, right? So money, fiat, and Bitcoin. So we need to start with some myth busting and a bit of education, looking at the foundational differences between these things. So there are ideological roots in both fiat currencies and crypto, and we need to get into those conclusions. So it's about the stability that fiat money offers. That's on one side, versus the scarcity-driven appeal of Bitcoin.
Yeah.
And fiat money, which money by decree, relies on government backing rather than physical assets.
I want to ask you a question. Now, you've talked about fiat currency and you've talked about fiat money. Is money and currency the same? Because I have read that there is a difference. Some people consider there's a difference between money and currency.
Yeah, it's a good question. Most definitions of money are that it's divisible, freely exchangeable, and fungible. It doesn't. I don't think it actually impacts this debate per se. You need to get into when I'll jump straight to what I think is the conclusion here, which is that the technology that underlies crypto is a solution searching for a problem, and we have applied the problem. We've applied it to the problem of currency, because it's not money, right? You can't pay for anything really in Bitcoin. Now, people who are really into this will be sending me emails and messages saying, "Oh no, but you can do sort of direct
buy coffee."
Yeah. Well, there have been plenty of sort of publicity stunts where people have paid for things in Bitcoin, but the majority of those actually know the payment provider that sits between you and the merchant is the one that's actually taking the Bitcoin, and they're giving, or the whatever currency you're paying in, whatever digital currency you're paying in, and they're then giving the merchant fiat currency, right? Because it really comes down to one thing, that as a merchant, do you want to receive a currency that is inherently volatile, right? And I guarantee that merchant, in the case of your coffee example, has to buy coffee beans in dollars. They have to pay their staff in dollars. They have to pay their heating, their electricity in dollars. And they've just been handed an asset which is inherently volatile, and they have no idea actually what it might be worth tomorrow. So you tend to find that those PR examples actually are just trickery with payment providers. There are some cases, and the technology exists today, you can directly pay people, cutting out almost the payment provider doing that intermediate currency conversion. You can pay people directly in digital currencies if they accept it, but that's a very niche market. You'll find that most of the big examples where people have sold a property in Dubai or undertaken some transaction are more for publicity than a functional business. I mean, there are plenty of examples in emerging markets where that isn't the case, but the vast majority of transactions aren't like that.
Okay, and interestingly, I was listening to, and I need to check the name of the writer. Actually, I was listening to a podcast the other day about money, sort of history of money, and they gave an example of, I think it was in Kenya, it was started, of a system called M-Pesa, where actually most people don't have smartphones, so they can't use cryptos to make payments or to send money to family and friends, out away from the city. And it's a sort of phone-based money transfer system that uses pin-secured text messages, and you're using basically paying, sort of pay-as-you-go credits as a form of money or currency. But that's because they don't have smartphones. So you've got to have a smartphone first of all to be able to access the blockchain, I guess. And so it's not going to be for everyone anyway.
Well, we're dancing around the principal point here, which is that all of these applications are where there has been some crisis in trust. Okay? So in the case of emerging markets, quite often you have some very volatile currencies. And when compared to those volatile currencies, actually some digital assets look remarkably benign. And they quite often are more freely exchangeable than certain capital-controlled economies. So there are use cases out there. But I think if you go back to the origin of Bitcoin as an example, and we shouldn't conflate other digital assets necessarily with Bitcoin, but Bitcoin being the largest, we'll focus on it. It's fundamentally a product of a failure in trust in the financial system in 2008. The currency, global currencies are a product, well, fiat currencies are a product of state power and trust. And the theme we talk about a lot on the pod is that the system works because we all want it to work. Yeah. And so if you go back to 2008, in the midst of the financial crisis, when there was inherent distrust in the system, I think a skeptical public, or a certain cohort of the skeptical public, did not like the idea of central banks being lenders of last resort and doing QE and ultimately using the tax base to what they saw as sort of reckless financing of the economy. So I think that's the kind of libertarian argument of why people like this idea. But again, since the Bretton Woods collapse, fiat currencies, people forget, have given governments so much flexibility to manage inflation, enact economic stimulus, respond to crises. And they're critical tools in modern economies that you just cannot do with a currency that has a hard cap of 21 million coins. Right? Yeah. And that's the most, I think, and this is where I want to get most emphatic, the most appealing characteristic to those inflation hawks that believe, inflation everywhere all the time is a monetary phenomenon, and they're wary of central bank control. They see Bitcoin as the answer to that. But the point that everyone forgets is that by artificially restricting the supply of a currency, you're inherently creating a deflationary force in the economy, right? Because if you physically cap the amount of money you have in the economy, when the supply of money is restricted, the scarcity of currency increases its value relative to goods and services because you can buy more goods and services with a given amount of currency. Right. So it reduces overall prices in the economy in a deflationary effect. Now, I appreciate people might have to go back and re-listen to that, but my point is deflation, guys, is not a good thing for an economy. It's something that people assiduously avoid. The Japanese central bank and government have spent nearly 2 decades trying to get the economy out of deflation. Deflationary spirals are a bad idea. And here we are saying that this is the future of currency when it is an inherently deflationary force by construction because of that capped amount. Okay. The beauty of fiat currency is that it's flexible. Now, that's not to say it cannot be recklessly abused. And there's lots of international examples about that. And you have to go to areas of the world that have poor governance and lax systems and controls and perhaps independence between central banks and politicians. Nonetheless, that doesn't, the fact that it's flexible is a good thing. It's about the ability of a currency to absorb economic activity, asymmetric shocks, and things like that. So I think that's that scarcity point that crypto advocates say is the best thing about crypto, I view from an economic lens as a terrible thing for a currency. But let's not necessarily just beat crypto with the currency stick. Yeah. As a store of value. Now this is where it gets interesting, I think. So it's a scarce resource. It's a scarce resource like gold. But although gold has some production value because you can physically use it, perhaps art is the better comparison, although one would argue you can appreciate art, perhaps not if you lock it in a vault deep underground. But it's, as a stable functional currency, I think its volatility, its scarcity, and a whole heap of other factors make it, and we'll come on to the problems with settlement and things like that shortly, but it's quite lousy. But as a store of value, interesting. But I would just caution people because history is littered with examples where things are only worth something because everyone else thinks they're worth something. If something doesn't have any intrinsic value, you're relying on the system to say it has value. And I'm not suggesting, by the way, that overnight this thing's going to go to zero, but I'm just trying to encourage people to understand what is actually driving Bitcoin as an example. And if you can go and look at some charts and you can go and do some econometrics and you can say, well, actually liquidity, global liquidity seems to be seems to have a very high correlation with Bitcoin prices, and there's a few other factors as well.
Okay, what about the case? I guess some people would argue that, well, we're saying then, or you're saying possibly that the Bitcoin is based on faith because it doesn't have an intrinsic value. Some people would argue that fiat currencies are also based on faith, as we no longer have the gold standard.
Yeah, but this idea that you need to have some shiny metal in a vault somewhere to back a currency, I think is misplaced. I mean, we have, the system works because we want it to work. You know, taxpayers, rule of law, governments, and ultimately, you know, armies. Because if you go back through history, that's how this works. The system itself, I don't think has a trust issue. I find, as I said, again, we're focusing very much here as currency, comparing fiat with crypto. The other thing as a currency, and this is a bit I think is the most concerning thing for me, once we have 21 million Bitcoins mined, what is the incentive for miners, or no, not miners, sorry, participants in the blockchain to actually settle transactions, right? Because ultimately, in order for the system to work as a usable currency, you have to be able to undertake a transaction. For those that are interested, they can go and read an excellent Bank of International Settlements paper that talks all about this. And for those that aren't familiar with the Bank of International Settlements, this is its bread and butter day job, settling international transactions. And without the price of Bitcoin continually going up and coins available to be mined, it's a bit dubious what the incentive would be as a participant in the blockchain to settle a transaction. Now, there are fees associated with settling transactions, but those fees alone are probably unlikely to support the system, because there's basically a free rider problem in this system that makes, I think, the future of it as a currency look a bit uncertain.
Are we saying essentially then that if we get to a point where all the Bitcoins have been mined, people will hold on to them because they're going to increase in value?
Well, I think that's, as a store of value, yes, I think that would be the kind of behavioral side of it. What I'm talking about is then its ability to be used as a currency and do transactions.
But you wouldn't pay for stuff with it because you think, if I wait until tomorrow, I'm going to get a bit more bang for my buck.
Yeah. Well, there is that, but I think what I'm talking about is sort of the plumbing of actually how the blockchain works, how individuals within it, ultimately through raw computational power, decide which transactions get sort of added to the chain. And there's no incentive really to do that on a fee basis alone once you've mined all the coins that are in existence. So I think that's sort of leading us into, well, why would you want this then? So I'm sorry I've been a bit emphatic about this as how lousy it is as a currency, but let's look, I think, at the second point, which is more about, well, okay, if not a currency, how could you use it as a complement perhaps to traditional finance, or as a store of value? Let me try and give a different perspective there. And I thought perhaps we should talk about this in the context of innovation, right? So it's entering, I would say it's now entering mainstream finance. You can go on Bloomberg or any other data provider and you can look at various ETFs that are now available. And obviously Bitcoin is pretty much their largest holding, or their entire holding in the case of most of them. And I think that's also why you've now seen this sort of enter the electoral cycle. I've not known an election campaign, and I'm talking, listeners, about the US election campaign and election last week, where cryptocurrency is featured so highly. So it is definitely entering mainstream finance. And you see examples out there of, Bitcoin and Ethereum that have integrated into traditional portfolios. And that in itself is sparking a whole sleuth of sort of regulatory challenge and changes. And we should talk probably about the environmental costs as well. So the chart, so why would you want this in a portfolio? And this, I think, is an interesting question. Now, there's obviously the speculative nature of the asset class, which we've been talking about, that there are just advocates out there that just would see this for no real intrinsic reason, just go up, right? And it's a pure speculative play. I don't think that's the main reason institutional investors are looking at it in portfolios. They're looking at it as a source of tracking error. And if you do some analysis on it and you look at its positive correlation with tech stocks, particularly during periods of high liquidity and risk on sentiments, you're basically getting a 3 times leveraged play against the NASDAQ. So go and plot a 3 times leveraged basket of tech stocks against Bitcoin. You essentially get the same chart. So you're getting high volatility into a portfolio, which at points in the cycle when liquidity is expanding and there's a risk on sentiment, that's quite attractive. If you're in that business, if you're that kind of portfolio manager, that kind of fund manager, that could be quite attractive. I think the other purported benefit is supposed to be that it's an inflation hedge. You hear that an awful lot, but again, listeners, go and look at the chart. It's extremely volatile, and Bitcoin price can actually react if you go and just look at how it behaves in different inflationary environments, it can behave very unpredictably to inflation surprises, and actually even negatively. So in 2022, a huge inflation shock, Bitcoin did nothing for you in that environment. So I think it's about volatility, and I think so in portfolios, it's interesting, I think, if you look at it through that lens. That would be my take on it, because I want to remove the kind of more speculative side of this. And big institutional investors are obviously moving into that space, and I won't mention who they are. They're some of the largest institutional investors in the world. And then regulators now are obviously over this with forensic attention, because the SEC in particular under Gary Gensler has pursued lots of regulation that would place crypto under the same laws governing traditional securities. Now, there is obviously a question of whether that will continue under this incoming Republican administration, and I think if you then lead that to its conclusion, that explains a lot of the recent rally.
Yeah, so we're saying then essentially that if you were a portfolio manager and you were considering putting cryptocurrencies into a portfolio, very volatile, they don't really have kind of fundamentals that you can properly kind of track and look at and watch, very unpredictable performance, but what they do have is this very high correlation to tech stocks, and it's a proxy for tech stocks, or tech stocks are a proxy for crypto. I don't know which way you want to put it, but essentially you're going to get something similar, but it's going to be volatile.
I think that's the way I would look at it. And there are lots of opinions, listeners out there on this topic, and I am by no means always right all of the time. But when I look at the chart, it does look like that. It looks like it's something, and again, at different points in its history, it's been driven by different factors. But if you look at its relationship with liquidity, if you look at its relationship with kind of risk on sentiment, you can see there is a relationship there. There is a statistical relationship. So people will argue there might be other reasons for that, but that to me is why you might want it. It's kind of like a very high octane exposure to sentiment. But some people out there are taking a different view. I think before I said we might touch on the environmental considerations.
Definitely.
Because I think when we talk about its integration with traditional finance, that does come at a cost. It comes at the cost of sheer carbon output. So all those Bitcoins, while they're still out there to be mined, and they get increasingly more difficult to mine, obviously, as the length of the chain gets longer, and the number of computational cycles required to generate or find a coin is greater and greater. It's kind of unsurprising that all this mining activity is happening in places where electricity is ruinously cheap. And there's loads of stats out there that, the carbon footprint of Bitcoin mining is the equivalent of entire nations, such as New Zealand or Ireland, I think. I mean,
I've seen those numbers,
And we talked a bit about the energy consumption of data centers about 6 months ago. It pales into almost insignificance compared to this. So to mine these things requires a lot of carbon, and actually to keep the network running compared to a traditional payments network requires a lot more carbon. And I'll give you an example. I mean, I said that mining is happening in places where electricity is ruinously cheap. One place is in North Kosovo along the Dniester River, and it was, Soviet era investment in energy generation, over investment that supported all these heavy industries and factories that are no longer there, that has been turned now towards Bitcoin mining, where electricity is essentially free or cheap, is where this stuff happens. So I kind of find it a little bit ironic that under a Soviet system which abhorred the concentration of wealth, is now today where people are trying desperately to concentrate wealth through Bitcoin mining. But it's this carbon footprint point that I think you can't ignore. And some regions are actually legislating to try and make this thing carbon neutral or encourage green mining. So again, similar to data centers, there are other ways you could power this using renewable energy, trying to balance crypto's growth with environmental sustainability. But if anyone has seen one of these sort of mining operations, they're generally racks and racks and racks of graphics cards in giant warehouses. They're not. I think people have got a vision of someone upstairs in a room with a computer mining Bitcoin. It's an industrial level operation.
Yeah. And is that, forgive my ignorance, because I still can't really fully get my head around the concept of mining Bitcoin. What role can AI play in this? Can it simplify this, speed it up?
No, it's a short answer, because what we consider AI today, the contemporary definition of AI is these large language models that we all now love and use. So ChatGPT as an example. And they're once they're trained and up and running, we can deploy them to sort of different tasks. Quantum computing could be something you could direct towards this. But at the moment, non-lab applications of quantum computing are very narrow. So you need it's basically raw computational power you need to apply. And it's effectively a random process. You have to put in the clock cycles. Yeah, and then your probability of mining Bitcoin increases effectively. Yeah. That's a very simplistic sort of summary of it.
Now, you had a very interesting point when we were chatting about this beforehand. So 2008 was when Bitcoin first kind of came to the world. Two businesses that were also started in 2008.
So this is my healthy dose of skepticism. If you've listened to what I've said and you say, well, David, no, this thing is the future still. It is the future. I would say, we've been waiting an awful long time, guys, right? Since 2008, there was a crisis in trust in the system. Bitcoin was created for those reasons I described. Two other firms were also created in 2008 that were disruptors, Airbnb and Uber. So Airbnb has completely disrupted the hotel industry. Uber has completely disrupted the cab industry. And Bitcoin hasn't disrupted currency yet. And we are still waiting. Yeah. So I just encourage, true disruptive industries it doesn't tend to take this long. Yeah. As I said, it's a solution searching for a problem. I think it's when we get on to the third section. In fact, should we talk about the future applications?
I was going to say, let's talk about, as you said, a solution looking for a problem. Let's see if there are some problems out there that blockchain could be the solution for.
Well, I've mentioned a couple already. So in emerging markets, Bitcoin is a hedge against a distressed economy. Because if you're in an emerging market that has poor institutional governance and there's a huge crisis in trust in the central bank's ability to run the economy, then Bitcoin does look like an asset of choice if you have hyperinflation or restricted financial policies. So Venezuela, Nigeria, citizens regularly use crypto as a hedge against unreliable fiat systems. But that doesn't mean all fiat systems are unreliable. Yeah. It's about governance and rule of law. And if you do surveys or in those emerging markets and compare them to Western markets, you find obviously people are very, very keen on crypto. So there's one use application already. But I think the interesting applications for digital ledger technology, which is the technology that effectively underpins these different coins and currencies, is not in the world of finance. I actually think it's in things like medical records, driver licenses. So you're on holiday and the unthinkable happens. You get hit by a bus in a foreign country. If you had a decentralized system of medical records globally, then that doctor immediately could access your medical record in hospital in a different country, in a different part of the world. Similarly with driver licenses, passports, obviously, there are huge benefits to having your personal information secured in a decentralized way, which means wherever you are in the world, you have access to that. I think that's really compelling, actually. And then you can go into actually some other interesting store of value use cases. We've actually at the bank been exploring a few of these. I'll mention a couple which we've looked at a very high level and one which we've looked at in some detail. The ones we've looked at a higher level are things like fractionalization. So you could take priceless pieces of art, fractionalize them, turn them into effectively an n number of underlying components which you can assign a value to, and allow people to own 1/nth of a priceless masterpiece. You could do the same with any kind of lumpier liquid asset. You could fractionalize using digital ledger technology. The one we've looked at in some detail, which I think is really interesting, because remember, this is a really fascinating technology that's a solution to a lot of very cumbersome databases. And the world of finance and financial services is glued together with about 4 decades of unbelievably antiquated, in many cases, systems, programming languages, databases, APIs, all that have to try and talk to each other, which means anyone that's worked in financial services that's had to be part of a big tech deployment knows how complicated it is. Digital ledger technology has the potential to take multiple databases, get rid of them, and just put them onto one decentralized ledger. So I'll keep it really simple. If you have someone that is ultimately a shareholder at one end of the stream, and at the other end of the stream, you have a big global investment manager, in between are obviously loads of custodians and different transfer agents and all these complicated bits of plumbing that have developed over 40 years with different databases and different computer programming languages. You could get rid of all of that and just have everybody on one decentralized ledger, which means when you have to wait T+3 for something to settle, when everyone's out there trading a fund or trading a security, they might think, well, what's going on in those 3 days? Why can't I just settle my proceeds instantly? Well, what's probably going on is multiple operations teams are doing reconciliations and confirming things, passing it to other people to confirm more things, et cetera, et cetera, et cetera. With DLT, with digital ledger technology, you could effectively remove that to instantaneous settlement. In theory, it's complicated because of just how complicated the system is. So there's lots of applications. I think the final one which I'll touch on is central bank digital currencies, and that one I think is obviously being explored by the Bank of England and a number of other central banks. When you actually look at central bank digital currencies, they actually look remarkably like centralized systems. Okay, so the bank, going right back to the beginning, the Bank of International Settlements, in order to settle central bank digital currencies quickly, you need basically a centralized database in order to do that. So they're called central bank digital currencies, but if you actually look at the architecture, they look remarkably like centralized currencies. Why? Because they need to be able to be settled quickly.
Okay. What about things like blockchain gilts or digital gilts? I've heard talk of this. Yeah,
there's lots of on-chain assets that have been issued on-chain out there, and they use sort of smart contracts, basically. There's quite a few bond issuance examples, not just with government bonds, but also with corporate bonds as well. And they're being done as either proofs of concept or pilot programs, and it shows that there is definitely a market for that out there, and there's efficiency savings and cost savings. But we're not going to fully realize the benefit of this kind of technology until everyone in the ecosystem uses it. You need to have every part of the financial architecture using it.
Okay. So I suppose in summary, we're not writing off cryptocurrencies, and we're certainly not writing off the technology that sits underneath. We're arguing, and I think probably a lot of people are arguing, I don't think we're out on a limb here, that cryptocurrencies don't meet the definition of a currency, a traditional currency. They can be a store of wealth, highly volatile, unpredictable in the way that they'll behave, appear to be highly correlated to tech stocks in certain situations. And there are big question marks about the sort of environmental impact of mining of cryptocurrencies. But we're saying that there are definitely uses for the blockchain. I like your point that it's a solution in search of a problem, and it probably was a solution that, as you say, that nobody actually needed. But there are possibly problems out there that blockchain could be the solution for, whether it's decentralized or centralized medical records, personal records, whatever it might be. there's possibly a use out there.
Yeah, I agree. That's my take on it. And time will tell as this, as adoption increases and as the liquidity increases and as the overall ownership of the asset base gets more diversified, I think you will see more institutional investors start looking at digital currencies. But again, I don't envision a world anytime soon where you'll be paying for your coffee on a UK high street using a digital currency, because the incentive structure to use traditional fiat right now is just much greater. And I'll leave everyone, I think, with one final thought, because we do have an incoming Republican administration in the US that has put this high up on the campaign trail. So if I'll caveat everything I've said, that if there is, though, a global race to adopt digital currencies driven by the US, it could ultimately politicize currency reserves. And if the US decides in some way to peg the dollar against Bitcoin or some other digital asset, that could have unintended consequences in the dollar. If you start pegging the dollar to a volatile asset, I think that so a lot of these things, I think they sound great. They're great on the campaign trail, but to actually implement them and politicize currency reserves and reduce and introduce an unstable element to dollar stability, I just don't think is attractive if you're actually in power governing.
Okay. On that note, thank you, David. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Until next time on Need to Know, bye for now.